Hello and welcome to Top Finance. For years, I grappled with the challenges of investing, often encountering setbacks. Determined to turn things around, I delved into the wisdom of successful investors. Join me as we explore 10 remarkable financial secrets gleaned from top investment books. Lesson 1. Compound interest. The concept of compound interest is often referred to as the eighth wonder of the world, owing to its powerful effect on wealth accumulation. It works on the principle of earning interest on the interest in addition to the principal amount. This means that with each passing period, the base on which interest is calculated grows larger as the previously earned interest is added to the principal. For investors, this is a potent tool, as it signifies that the sooner and longer one invests, the more significant the potential for growth. Over time, even small regular investments can grow into substantial sums due to the snowballing effect of compounding. For example, an investment that earns a 10% annual return will double in roughly 7.02 years, not just the initial amount, but also the accumulated interest from previous years. The key to harnessing the full power of compound interest lies in time and patience. By investing consistently and allowing the returns to compound, investors can watch their wealth expand exponentially. This is why starting early and staying invested over the long term is crucial for maximizing the benefits of compound interest. Lesson 2. Diversification. Diversification is a fundamental investing strategy that involves spreading your investments across various asset classes to mitigate risk. The rationale behind this approach is that different asset classes and sectors perform differently under varying economic conditions. By diversifying, you're not overly exposed to the risks of any single investment. For instance, while stocks may provide higher growth potential, they can be volatile. Bonds, on the other hand, often offer lower returns but come with less risk. Real estate can serve as a hedge against inflation and provide a steady income stream. By holding a mix of these assets, an investor can reduce the impact of volatility on their portfolio. Within asset classes, diversification is equally important. In the stock market, this means spreading investments across various sectors such as technology, healthcare, finance, and consumer goods, and also considering a mix of large cap, mid cap, and small cap stocks. Geographical diversification can protect against region-specific economic downturns and take advantage of growth in different markets. The goal of diversification is not necessarily to boost performance, although it can, but rather to reduce the risk of a significant loss. It's about finding the right balance between risk and return that aligns with an investor's risk tolerance and financial goals. Let's move on to the next point. Understand what you invest in. The principle of understanding what you invest in is a cornerstone of intelligent investing, famously championed by Warren Buffett. It's based on the premise that one should invest within their circle of competence, which means sticking to industries or businesses that you are familiar with or have knowledge about. This understanding allows investors to make more informed decisions, evaluate the potential risks and rewards more accurately, and recognize when an investment may not be performing as expected. When investors venture into markets or instruments they don't fully comprehend, they expose themselves to higher risks. Complex financial products or industries that are outside of one's expertise can harbor hidden risks that are not immediately apparent. For instance, during the financial crisis of 2008, many investors suffered losses from mortgage-backed securities, a product they did not fully understand. Buffett advises that by focusing on businesses with straightforward, predictable, and proven business models, investors can better anticipate challenges and opportunities. This doesn't mean one should avoid learning about new investment opportunities or expanding their circle of competence. But it does mean that investments should only be made once a thorough understanding is achieved. This approach helps in making more confident and potentially more successful investment decisions. Ready to next lesson? Emotions are investors' enemy. Emotions can be a significant adversary in the realm of investing. The emotional responses of fear and greed are particularly potent, often leading investors astray. Fear can trigger panic selling when markets dip, causing investors to sell assets at low prices and lock in losses. Conversely, greed can drive investors to chase performance and buy into overvalued markets or assets, ignoring fundamental valuations and leading to potential bubbles. These emotional decisions are typically reactive to short-term market movements and can derail a well-considered investment strategy. To counteract the influence of emotions, investors should cultivate discipline and maintain a long-term perspective. This involves adhering to a predefined investment plan that aligns with one's financial goals and risk tolerance rather than being swayed by the market's ups and downs. A disciplined approach includes regular portfolio reviews and rebalancing to ensure alignment with one's investment strategy. By focusing on long-term objectives and not the short-term noise, investors can navigate the markets more calmly and make decisions that are rational rather than emotional. Lesson 5. Market timing. Market timing is the strategy of making buy or sell decisions of financial assets by attempting to predict future market price movements. The difficulty with market timing lies in the unpredictable nature of the market. It requires precise predictions about future events, which is nearly impossible consistently due to the complex and dynamic factors that influence market prices. The challenge is compounded by the fact that markets tend to react very quickly to new information, often before individual investors have the chance to act. Moreover, emotional biases and the herd mentality can lead to poor timing decisions, buying when prices are high out of optimism or selling when prices are low out of fear. A buy and hold strategy, on the other hand, is based on the belief that financial markets will provide a good rate of return over the long term, despite periods of volatility or decline. This approach involves selecting high-quality investments and holding them over an extended period, allowing investors to ride out the ups and downs of the market. Historically, the markets have tended to increase in value over time, and the buy and hold strategy exploits this trend. It also benefits from compounding returns over time and can be more tax efficient, as it typically results in fewer taxable events. Additionally, it avoids the costs and fees associated with frequent trading. For most investors, particularly those without the time or expertise to analyze market movements closely, a buy and hold strategy may lead to better long-term results than attempting to time the market. Another crucial lesson is the efficient market hypothesis. The efficient market hypothesis, EMH, posits that it's impossible to beat the market consistently on a risk-adjusted basis because stock prices incorporate and reflect all relevant information. This hypothesis is a central tenet of modern financial theory and suggests that stocks always trade at their fair value, making it futile for investors to search for undervalued stocks or to try to predict trends for higher returns. While the EMH is a strong argument for market efficiency, it's not without its critics. Markets are not always perfectly efficient due to factors like investor irrationality, regulatory changes, or information asymmetry. However, the EMH serves as a useful reminder that making investment decisions based on the belief that one can consistently outsmart the market is often a losing strategy. This is where passive investing comes into play. Passive strategies, such as index fund investing, are built on the premise that matching the market is more achievable and cost-effective than trying to beat it. Over time, passive funds have often outperformed actively managed funds, especially after accounting for fees and taxes. This is partly because active fund managers not only have to beat the market to justify their fees, but also have to do so consistently, which is a tall order, given the market's efficiency in processing information. Lesson 7. Margin of safety. The margin of safety is a principle of investing in which an investor only purchases securities when their market price is significantly below their intrinsic value. Essentially, it's a buffer that helps protect investors from estimation errors, market volatility, or any unforeseen events that could negatively impact the investment. Benjamin Graham, known as the father of value investing, introduced this concept as a core philosophy in his book, The Intelligent Investor. The margin of safety is determined through fundamental analysis, which includes evaluating a company's financial statements, understanding its business model, and assessing its management team, among other factors. The intrinsic value is an estimate of a company's true value, which can be different from its current market price. By insisting on a margin of safety, investors aim to minimize the potential for loss. For example, if an investor determines the intrinsic value of a company to be $100 per share, they might only decide to purchase the stock if it's available for $70 per share. This $30 difference represents the margin of safety, offering protection against errors in the investor's analysis or unforeseen market downturns. The margin of safety principle encourages conservative investment decisions, focusing on long-term performance rather than short-term gains. It's a risk-averse approach that doesn't guarantee success, but aims to reduce the likelihood of substantial losses. Lesson 8. Asset allocation matters more than stock picking. Asset allocation is the process of dividing an investment portfolio among different asset categories, such as stocks, bonds, real estate, and cash. The practice is based on the understanding that different asset classes have different levels of return and risk, so each will behave differently over time. The idea is that by selecting the right mix of assets, investors can optimize the balance between risk and return. Numerous studies have shown that asset allocation is one of the most important determinants of long-term portfolio performance, often more so than the individual securities selected within each asset class. This is because the choice of asset allocation reflects an investor's risk tolerance, investment horizon, and financial goals, which are the primary drivers of investment outcomes. For example, a young investor with a long time horizon and a higher risk tolerance might allocate a larger portion of their portfolio to stocks for growth potential, while an individual nearing retirement might increase their allocation to bonds and cash for income and stability. The key takeaway is that while stock picking can contribute to performance, it is the broader allocation that sets the overall risk and return profile of the portfolio. A well-diversified asset allocation can help cushion against market volatility and reduce the impact of poor performance in any single investment. Here is the lesson 9. Costs matter. Investment costs can have a significant impact on net returns, and as such, they are a critical consideration for any investor. High fees can erode the compound growth of an investment portfolio, potentially costing investors a substantial portion of their earnings over time. Expense ratios, which are the annual fees charged by mutual funds and exchange-traded funds, ETFs, can vary widely. A higher expense ratio can diminish the effective return on investment, especially over long periods. For example, a 1% higher expense ratio can reduce the ending balance of an investment portfolio by 20% or more over 20 years, assuming a 5% annual return. Transaction fees are costs incurred when buying or selling securities. Frequent trading can lead to higher transaction costs, which, like expense ratios, can reduce the overall return on investment. Tax efficiency is another important aspect of investment costs. Certain investment vehicles, like index funds and ETFs, are more tax efficient than actively managed funds because they tend to generate fewer capital gains distributions. Investments in tax-advantaged accounts like IRAs or 401k can also grow tax-free or tax-deferred, enhancing the compounding effect. Investors should always be aware of the fees associated with any investment and understand how those fees affect their potential returns. By choosing low-cost investment vehicles and adopting strategies that minimize fees and taxes, investors can keep more of their returns and benefit more fully from the power of compounding over time. The lesson 10 will change your finance if applied wisely. Risk and return. The relationship between risk and return is a fundamental concept in finance, which holds that the potential return on any investment is correlated with the amount of risk the investor is willing to take. Generally, investments with higher risk are associated with higher potential returns, while lower risk investments tend to offer lower returns. This principle is rooted in the risk-reward trade-off. To entice investors to take on more risk, the potential reward must be greater. For example, government bonds are considered low risk and thus offer lower returns, while stocks are riskier and can potentially deliver higher returns. Understanding one's risk tolerance is crucial. It involves assessing how much volatility an investor can handle without making impulsive decisions. It's also about how much capital an investor can afford to lose without affecting their financial security or lifestyle. An investor's required rate of return is the minimum return they need to achieve their financial goals. This rate should be determined by considering both the investor's financial goals and their time horizon, along with their risk tolerance. An appropriate investment portfolio is one that is tailored to an investor's specific risk tolerance and required rate of return. It should be diversified across asset classes to manage risk while aiming to achieve the desired returns. By aligning the portfolio with these personal factors, an investor can work towards their financial objectives without taking on undue risk. Thank you for watching. Please don't forget to subscribe and turn the notification bell to stay updated with our content. Have a wonderful time. I will see you in the next video.